We'll come to how that happens. Margins, currently maintenance. If you go to margins, it's $2,900 per contract. So if I'm short 10 contracts, I'm going to have to maintain at least $29,000 in a margin account. This is kind of a collateral. And that account is settled daily. So at the end of each trading day, using the so-called settlement price, which is, I think, the average prices in the last minute or so of the trading day. You're not using just the close, and you can see the settlement procedures and the specs. Actually, you can read about it. That was the settlement price for yesterday. Or you can see in the quotes, that's the prior settlement. And we're going to see the role of that in management of such a position. So let's make up a hypothetical scenario. Assume you owe euro 20 million of various maturities. You're an importer and you're going to pay these guys in euros. You bought stuff from Germany and various maturities, you're going to have to pay 20 million euros. If the value of euro increases, are you going to be happy or unhappy? Hmm? A little bit louder, please. I can't read lips. And this is not an ASL class, so what currently dollar euro is, or euro dollar is 116.50. Suppose dollar euro went to, 120.60. Are you going to be happy or unhappy? Unhappy because you owe euros. So your natural position is short. Which means price increases make you unhappy. If price increases make you happy, that's called a long position. If people owe you euros, you want euro to increase in value. and price increases make you money. That is the long position. So that's my natural position. Because of my normal business, I have a certain position. But I want to hedge that exposure. The price, if dollar euro goes up, I know my natural position, I have to pay more in US dollar terms. So I need an instrument that's going to make me money when that happens. To hedge, you need the reverse position in the futures markets. So in this case, should I establish a short position or a long position in the futures market? Anyone? My natural position is short. So to hedge myself, should I have a long position or a short position in the future? Long, because long is opposite of short to balance each other out. If euro goes up, yes, I'm going to pay more in dollar terms for my natural obligations, but I will also make money in the futures market. So they're going to cancel each other out.
With that, do you ever make a profit margin? Because if they're both just bouncing out, you just
That that is the definition of the word hedge. Okay, they cancel each other out. I mean, there's a minor risk that sometimes in futures market weird stuff happens. Not in exchange rates, but in commodities. Other than that, uh, whatever you lose in the natural position, you make in the futures position, or vice versa. If there is a difference between the two, that's actually called the basis risk. And sometimes you have that in commodities markets and sometimes in interest rate markets. We'll come to that later during the semester. One example was, uh, especially in commodities markets, you may have short squeezes. Okay, uh, if somebody's short in the futures market, that means they promise to sell something. Okay, suppose I shorted the crude oil. That means when the contract day comes, I promise to sell this many barrels of oil. In crude oil, contract size is 1,000 barrels, which is equivalent to 42,000 gallons, I think. But, you know, I promise to sell it, but either I have it and I sell it, or I'm going to source it from the spot market at the time and sell it. Remember, this is a physical commodity. Uh, Sometimes when there are too many shorts, the people in the physical market starts buying it ahead of time, and there aren't enough oil to buy in the market. So those guys have to buy it and deliver. That means spot market prices goes up quite a bit. Of course, futures respond to that as well. You're squeezing the shorts. Oddly enough, there can even be long squeeze. This happened during COVID days. It created something almost everybody thought that it was unthinkable. It created negative crude oil future prices. Negative. So if you basically promise to buy crude oil, people actually paid you money to buy the uh, to sell this stuff to you. That's what a negative futures price is. That has to do with When there's a long squeeze, there are too many longs. And well, somebody has to sell to them at some point, right? But those people who were long in the futures market, because spot prices were so low, everybody thought that at some point they're going to go up. So if that's your expectation, you want to be long in the futures market. Okay. But those people who bought all that stuff in the spot market, they have to store it somewhere. And there's a finite capacity to store the crude oil before it's extracted, after it's extracted. At some point, there was so much stuff bought in the crude spot market. Goldman Sachs had tankers that were full, but there weren't any buyers for that yet. And they were simply going back and forth between Boston and New York. As soon as that capacity was filled, futures prices tanked, and they were negative at some point. It has seen negative $37 back in summer of 2020. 'Cause nobody was using oil for anything.